My name is Stephen ViCorpo. I'm in the Accounting 101 class at Coastline College. This will be a QuickBooks representation of problem AP5-1A from Wiley Plus. First of all, I've created a Jansen Hardware Store and set up the accounts, Jansen Hardware Store, set up the accounts out like this. The accounts get set up like this way. What kind of account you want, say equity, continue, you put in the name of the account, and so forth and so on. And then you create these accounts: cash, accounts receivable, merchandise inventory, supplies, accounts payable, payroll, liabilities, ones that most of these pertain to the question at hand. After I created the chart of accounts, I started to do the journal entries, which it says Jansen Hardware Store completed these merchandising transactions in the month of May. At the beginning of May, Jansen's ledger showed cash of $81.78 and common stock of $81.78. So the first journal entry is a debit to cash of $81.78 and credit to common stock of $81.78. And that's by selecting cash from the account list, putting in the debit to common stock. And it's as of 4/30/2013, and we're going to be dealing with the next month. Then the first thing on the problem was May 1st. Purchase merchandise on account from Vanco Wholesale Supply, $9,900, terms 210 and 30. For that, we have a debit to merchandise inventory of $9,900, which is the purchase from Vanco, and then a credit to accounts payable of $9,900. The next thing on the problem was sold merchandise on account, so $5,700, terms 310, net 30. The cost of the merchandise sold was $33.73. That journal entry is a debit to accounts receivable for $5,700, then a credit to sales of $5,700, and then to account for the cost of the merchandise, it's a debit to cost of goods sold $33.73 and a credit to merchandise inventory of $33.73. The next one is May 5th. Received credit from Vanco Wholesale Company Supply for merchandise returned, $400. So accounts payable gets debited for $400. Merchandise inventory is credited for $400. Next journal entry was received collections in full, less discounts from customers billed on May 2nd. As you recall, May 2nd was the accounts receivable was $5,700, and that's how much they were billed. Now on the 9th, we enter cash for $55.29. Sales discounts $171 because it was paid before the due date, and then accounts receivable gets credited back $5,700. Next one, paid Vanco Wholesale Supply in full, less discount. That's this journal entry. It's $9,500 to debit accounts payable. It's $93.10 cash is how much was actually paid, and the discount we got was $190, and that is a credit to merchandise inventory. Next one was purchase supplies for cash, $920. That was on the 11th. Yes, on the 11th. Supplies, which in this case is a current asset, because it is supplies bought and it's an asset and it's not expensed yet, is a debit for $920 and a credit to cash, $920. Then on the 12th, purchased merchandise for cash, $27.60. It will be merchandise inventory, gets debited $27.60, cash credited $27.60. Next day was the 15th, received $235 refund for return of poor quality merchandise from a supplier on a cash purchase. That would be a debit of $235 to cash, received in cash, and a credit to merchandise inventory for $235. Next entry was May 17th. Purchased merchandise from Strickler Distributors, $2,900, terms 210, net 30. Merchandise inventory gets debited $2,900. Accounts payable credited $2,900. The next one on May 19th, paid freight on the May 17th purchase. So the freight on this purchase goes to debit merchandise inventory, gets freight, it gets inventory freight, it goes to the cost of inventory, and cash credited for $256. The next date, the 24th, sold merchandise for cash for $55.20. The cost of the merchandise sold was $41.09. That'd be a debit to cash, $55.20, and sales $55.20 credit, and then cost of goods sold was $41.09, and merchandise inventory gets credited $41.09. Then on the 25th, purchased merchandise from Fasteners Inc. for $818, terms 310, net 30. Merchandise inventory gets debited $818. Accounts payable gets credited $818 for the purchase. And then Strickler Distributors in full, less discount. That the purchase was for $2,900, so it's a debit to $2,900, a credit to cash of $28.42, and in the merchandise inventory a credit of $58 for the discount. Then on the 29th, made refunds to cash customers for returned merchandise, $132. The returned merchandise had cost of $92. That would be a debit to sales returns and allowances for $132, and a credit to cash, $132, cash going out. And then a debit to merchandise inventory of $92 and a credit to cost of goods sold, $92. And on the 31st, sold merchandise on account, $13.08, terms N30. The cost of the merchandise sold was $8.48. That's accounts receivable gets debited for $13.08. Sales is credited for $13.08. Cost of goods sold for the cost of the merchandise was $8.48 debit, and merchandise inventory was credited for $8.48. Then on the problem it says journalize it. It says post the transactions to your accounts. Be sure to enter the beginning cash and common stock balances, which was done. Then complete the income statement through gross profit for the month of May. So first of all, we had to add in, because of the third part of the problem, operating expenses of $1,431. We had another journal entry, operating expenses, $1,431 debit, a credit to cash, $1,431. Then from there, we do the T accounts, and it gets represented in QuickBooks as a trial balance, with the debt balances here: debit balance of cash of $18.11, accounts receivable debit $13.08, merchandise inventory debit $75.13, supply debit $9.20, credit to accounts payable $8.18, credit to common stock $81.78, sales $12.528 credit, sales discounts $171 debit and $132 for sales return and allowances debit, cost of goods sold debit of $82.38, operating expenses $14.31 debit. And from there it calculates the profit and loss statement, which is the profit and loss statement. Which shows sales and the sales discounts, giving you total income minus the cost of goods sold, gives us a gross profit of $39.87. And then from there we have it calculates the balance sheet, which comes into balance, and it shows the cash is $696, merchandise inventory and supplies totaling $13,234, and the liabilities and equity $2,900, common stock, net income equaling the same, balancing out. Then it asked us to calculate the profit margin ratio on gross profit rate, assuming the expenses were $14.31. That would be done the profit margin ratio equals net income divided by net sales. That would be the gross profit minus the expenses divided by the net sales, gives us a profit margin ratio of 0.21. Gross profit rate is the gross profit divided by the net sales. The gross profit, as was shown up here, was $39.87 divided by net sales gives us a gross profit rate of 0.33. I think that is it. Thank you very much for your time. Goodbye.